Second hour of the Elias Macko Show. And as the music implies, it's getting serious. Ladies and gentlemen, thank you for listening. We're with you until noon. We're going to start off the second hour of the program by looking at investing and building a diversified portfolio, right? And some of you may say, oh, Elias, I'm diversified. I'm doing this. I'm doing X, Y, and Z. Others are like, Elias, I don't want to diversify. I'm all in on Bitcoin, and I'm going to go down with the ship. Let's talk a little bit more about how to make sure you are diversified properly when it comes to your investments. Richard Lapointe's with us, Senior Portfolio Manager over at CIBC Wood Gundy. Richard, welcome back to the show.
Thank you so much.
Okay, so listen, as most things in life, I'm of two minds, okay? I hear all the people saying, hey, you got to be diversified. You really do. You know, you don't want to be too many eggs in one basket. Diversification is the key. And then I see these people, like I'm on Reddit, and there are certain Reddit boards where you have these people, and boy, do they like to gloat and crow about it, where they went all in on NVIDIA, and now they're cajillionaires. And I say, why didn't I do that? Why am I so diversified? So, Richard, how do you see it here? What's the right mix?
So let me comment on your comment. As you can imagine, with 35 years of experience in this business, there's a lot of times I go, why didn't I do that? It's shocking, including NVIDIA recently, when it dropped down from about 140 to 90 some odd dollars. Although I did buy it for many clients, I really didn't buy enough. But here's the issue. We're talking about the holy grail of investing today, right? Diversification. People take that word wildly wrong. All right? I would point to some of the most successful investors of our generation, and they will tell you that diversification, in part, is a defensive and protective manner of investing. So, you buy some bonds and you put some money in cash or money market, and you buy yourself some Canadian stocks and some U.S. stocks and some international stocks. You own some real estate, and you're broadly diversified. And that sounds great on paper. But every time has a specific where things don't mesh. I'll give you an example. Right now, I buy a bond from the government of Canada. I'm going to get, for 3 or 4 years, I might get 3 points. After tax, that's 1.5 points to me, net.
Yeah.
Our inflation in this country is well above that. So by diversifying into bonds, I'm guaranteeing that portion of my portfolio will be losing money. So you don't want to do that, right? You don't want to lose money. So you don't want to diversify into that product at this point, even though the golden rule says you must have some bonds. Well, so every situation merits it. Give you another example, big example. Everybody talks about ETFs.
Yes.
Let's go out and buy ETFs. Don't buy your own individual stocks, buy ETFs.
Richard, just for our listeners here, before you get into your point, ETF, an exchange-traded fund. So what does that mean? Because, listen, I have an ETF. I have some ETFs. I think a lot of investors have it. But we hear this. Maybe not everyone is aware of what exactly it is.
So it is, for instance, let's use the ETF of the Standard & Poor's. The ETF, the exchange-traded fund of the Standard & Poor's, is all 500 shares packed into one unit, right? So they literally they take the money from all the people who they gather, and they buy all 500 shares in the proportion of the Standard & Poor's, the exact proportion, and create a unit called an exchange-traded fund. Now, this is the issue I have with ETFs. Not that they're bad. Not that you can't hold on to them for a long time and make money. That's not the point. ETFs are everything. Now, when I crack open an ETF, there's at least half of those stocks I don't like. Okay? And 500 names is a lot of names. Now, if I gave you a sum of money, Elias, you wouldn't split it up 500 ways. It's just not what you would do. So, again, it's a right tool for diversification, but is it?
And
right?
does it go down that path? Like when you were talking about before about how diversification, a lot of people have just gone wildly off base with the diversification, and I guess we get into over diversification.
There you go. That ding, 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 ding. You just hit the big number. So one of the things that happens whenever I bring in clients from other firms, usually from the firms that specialize in mutual funds specifically, I will get a client who will have 20 different mutual funds. So in effect, he owns everything, right?
Yeah.
So each mutual fund has a basket of stocks in there. They can range from 50 to 200, and they all like different stocks for different reasons. So you can imagine if you have 20 of them or 15 of them, you own everything. Now, you can go down a lot when you own everything. It's really hard to go up a lot. Because that would mean that the world would have to be in one great Cinderella-like situation where everything goes up at the same time. And this is a problem. Okay? This is an issue. So what I say is diversification, yes, but it has to have a proper measure. Can't be everything at all times just because you say diversification. And the last one, this is the big one. And you're going to think I'm tooting my own horn, but I'm really not. Most people like to diversify their investment advisors. This is the one that I struggle with the most. Because if you come into my office, I'll give you a reasoning for every investment that you make with me.
Yeah.
That may not be the same reason as my neighbor next door. The same financial advisor may think I'm completely off my rocker. So can you imagine getting two completely different opinions? How do you invest? Right? I'm a big believer that you should work with someone who really knows you and really understands you and you feel comfortable with, and that's it.
Yeah. And I guess it also comes down to like the risk tolerance, right? Because when you were talking about bonds before, right? You get 3%, if you're getting 3% now, and then you take into account that half of it goes to taxes, and then and then the rest goes to inflation, you're losing money right now. Some people would say, well, listen, at least I'm not going to lose my shirt. Okay, maybe I'll lose a bit, but I'm not going to lose 50% of my portfolio on bonds. But, so I know there's a safety there. But again, like it's about how much risk are you willing to take for what payoff?
One of the biggest issues we always face is we view risk as a one-sided blade. That if we buy something that's risky, we're guaranteed to lose. Every stock on the equity market has a degree of risk to it. But if you don't invest in the equity market now or the real estate market, and it depends which real estate, you are guaranteed to lose.
Yeah.
So I will never accept that a guaranteed loss is the way to approach things just because it can't go down 50%. Sorry, that's not the way to build wealth.
Let me ask you, Warren Buffett, Mr. Warren Buffett
yes.
and Berkshire Hathaway, they're holding on to a lot of cash right now, right?
Yes, indeed. But that's again misunderstood. So Warren Buffett's probably got one of the biggest equity portfolios you've ever heard of. I mean, he's got a lot. And more importantly, the private equities that he owns. So he bought Burlington Northern, like RCN Rail, right? So Burlington Northern, he didn't buy some shares. He bought out the company. So when you say he's got a lot of cash, he might be holding 10 or 15% cash as a weighting to his total asset base, which is what I've got for my clients. It's just that his company's so bloody big that it sounds like he's holding on to a country's worth of cash.
But as a percentage, it's actually just par for the course.
Yeah, he is all in on the U.S. And by the by, all that cash that he raised in the last little while, I'm telling you, he regrets it.
Hey, let me ask you this, and I got to be quick here. Are you all in on the United States, like their economy? Do you think that thing is just a behemoth, or are you?
So that's a big question, and I'm going to just start by saying these are my opinions, not those of the CIBC banks. But the answer to that is yes. Yes, I am.
Yeah, so interesting. Hey, Richard, come back real soon, okay? It's great talking to you.
Great pleasure.
Richard Lapointe, Senior Portfolio Manager over at CIBC Wood Gundy.